Evening, everyone. So you'll have to go gently with me because this is my first ever webinar. So forgive any errors I make. I want to start off by getting a bit of an understanding for how many of you know about creating a portfolio or portfolio analysis. So I have a little question I want you to answer, and so it's really how many of you have a portfolio, and it's just a yes, no. So if you wouldn't mind indulging me and just answering that so I can get a feeling for what sort of audience I'm chatting to. So if you can go ahead with that. Okay, we're almost done there. A couple of you still outstanding. 87% of the way there. So there's one or two of you who are just holding us up there. If you wouldn't mind just clicking the vote. Okay, we're going to close off that poll. Thank you very much. So it looks like we've got a pretty much a mixed bag here, because we've got a sort of almost half-half split between people who have got portfolios and people who don't have portfolios. Okay, so I'm going to take it quite gently then, because half of our audience haven't created portfolios before. So my brief tonight was to explain to you how to create a diversified portfolio. So creating a diversified portfolio, I'm going to start off with a little bit of theory. So what is diversification? So clearly, when you create a portfolio, you want to put together the right mix of shares. Those are shares that list on the JSE, bonds, property, and cash. Those are typically the main building blocks of your diversified portfolio. This is called your asset allocation. And really a lot of your variability and performance in your portfolio comes directly from this asset allocation. And there's this general rule of thumb which says that this is the most difficult part of putting together a portfolio, is actually choosing the asset allocation, and that the stock picking is actually the easy bit. So it's about not having all your eggs in one basket. So having a lot of shares doesn't mean you're diversified. You tend to go for variety, not quantity. So having 100 shares in your portfolio that are all the same actually doesn't make you diversified at all. It gives you a lot of risk on the same type of stock. So what you want to do is have a bit of a spread of shares in your portfolio. And I'll get to that a little bit later. I've got some examples on that. So clearly we want shares, bonds, property, listed property, international, and cash in that portfolio. So let's just go through those little bits, those buckets in more detail. So cash, typically you always have cash in a portfolio because there's typically some fees, you want some liquidity, it has the lowest risk in your portfolio, and it has the highest level of liquidity. So you tend to want to have this because there's always that little event that you have to pay for. So you've either got to pay for some school fees, you need to dip into your portfolio, or you need to buy a new car, and you need to disinvest out of your portfolio. So cash is quite important because it gives you liquidity. Bonds, otherwise known as fixed interest, they bring you the interest component. That's the income in your portfolio. So if you're someone who needs to live off a portfolio that has some income, that you need some income from it, you tend to put quite a lot of bonds in because that will give you an interest yield. Problem with bonds is they tend to be fairly low risk and don't give you a massive performance. But we'll come back to that one a little bit just now. Property is also important, listed property, and there's a couple of ways you can do this, and I'll get to that a little bit later. But property tends to be your protection against inflation, and it also tends to have a low correlation. That means it doesn't do the same thing as the other shares in your portfolio. But property tends to be medium to high risk, and depending on the interest rate cycle, could actually lose you money. So you put a bit of property in there, but not too much. And I'll get to that weightings a little bit later. And then equity. Clearly, equity shares are the powerhouse. They're the engine in your portfolio. This is what's going to drive most of your performance. But equities, they tend to be the highest risk part of your investment or your portfolio, and you need to take the longest term view on this. So let's have a look. I'm going to try out my little highlighter here. So on the slide here, what I'm showing you is why I say equities is the engine house. So if you have a look at this is 100 Rand invested since 1924. You can see what's happened to that. That's your equities component. That's your massive driver. Then you've got lower down here, you've got bonds and cash slightly outperforming inflation. But equities is by far the biggest driver of performance. Then on the right of the slide, what you'll see is the other thing that we always say to clients as well is maybe look at adding something like commodities to your portfolio, because if you have a look at this over the last 11, 12 years, commodities is also giving you this huge driver of performance in your portfolio, but it comes with risk. It tends to be quite volatile. Okay, so let's get rid of that. So moving on. If we look at historical returns, equities, as I've said, tends to be the driver of your portfolio. If you look long enough, over long enough periods, so sort of 20, 25 years, equities tends to give you between 15 and 18% performance per year. That's why you want to have quite a lot of equities in your portfolio. So whether you look at that, the returns 1925 to 2005, or look at the one on the right-hand side of my slide, you'll see equities is giving you around about 16, 17% performance over a long period of time. And that's what give you the most performance in your portfolio. Bonds, slightly lower, about 8%. And that is just outperforming inflation, which is running at about 6%. And cash is just a tiny little bit above inflation. So just having cash in your portfolio will probably not keep up with inflation after costs. So clearly you want to have quite a large chunk of equity. You want to have a piece of bonds, and you want to have some cash. The other thing about equities is if you're in the markets very short term, equities tends to have the highest risk. And that you can see there. If in a 1 year, if we look at, that's a 55 years that they've had a look at in this slide, you can see that equities could either give you a 50% up or minus 26% down. So that's the problem with equities over 1 year. And that's why equities and shares, you tend to have to hold them for the medium term to long term. So if you have a look, if you go 15, 20, 25 years, you'll see that you you never lose money with equities as long as you hold them long enough. So you'll see over 25 years, equities will give you between 17% up to 8% up. Tends to be the range. If you look at the right-hand side of the slide, you'll see that the longer you hold your shares, and this is, if you look at the 5 to 10 year period, there is no 10-year rolling period where equities actually loses you money. So the art on equities is you need to be in there. As I've said in the slide, time heals most wounds. You need to be in equities medium term to long term, because in the short term, you can actually experience quite a bit of volatility. The other thing about creating your portfolio is you need to ask yourself these sort of questions. Your time horizon. Unfortunately, if you're in a portfolio for very short periods of time, so let's say a year, 2 years, you need to have quite liquid, low-risk type investments. So you tend to have more cash, more bonds, less equities. So your time horizon will definitely determine how much of the different asset classes. Your appetite for risk. Now, I love risk. So clearly, someone like me, I've got time in the market. I've got quite an appetite for risk. I'm going to have lots of shares. I'm going to probably add some commodities, and I'm going to have less, and I'm going to have more listed property, but I'm going to probably have less cash and less bonds. You might have a low risk appetite. So you might want to have much more bonds, more cash compared to my portfolio. And then, do you need income? If you need income from a portfolio, then you need those asset classes that will drive a yield. So listed property, cash, and bonds will give you far more income than just having pure shares in your portfolio. Even within your shares, though, you can create more income if you look at stocks, shares that have a higher dividend yield, and that will give you a slight kicker in your income. The other thing is that you always have, life is about choices. So you always have this risk-return trade-off. So the more risk you're willing to take, the more return your portfolio will generate. So if you have a look at and I'm going to turn my little highlighter back on. If you have a look down here, this is a very low risk portfolio. So typically you're looking to outperform inflation by just a little bit, about 3%. So shares or equities will only form 40% of your portfolio. So, but then you'll only slightly outperform inflation, but the risk in your portfolio will be very low. If we go to the other side of our risk curve here, and we want to get CPI plus 7, so let's say CPI at the moment is about 6%. So CPI plus 7 would be about 13% performance. Well, there you're going to have a huge chunk of equities in your portfolio. So about 75%. So depending on your risk profile, you'll be somewhere along this curve. If you're someone like me who likes a lot of risk and is willing to take, you'll probably have even more than 75% equities in your portfolio. So let's kill that highlighter there. The other question I always get asked is, does your portfolio change over time? And clearly, if you're 20, you can take on a lot of risk, and if you're 65 and you're right at retirement, you can take on very low risk. So clearly, the older you are, the less risk you can typically take in your portfolio. So there always used to be this rule of thumb, which said, take your age and minus it from 100, and that used to give you your rough, what your equity should be in your portfolio. The problem with this rule of thumb is that people are now living longer. So, and you probably want to stay in employment and working and investing for a lot longer. So roughly now the rule of thumb is between 110 and 115 minus your age gives you your equities. So I've got a little chart where I've modeled this, and I've taken some US examples. So this is Vanguard and Fidelity or Offshore, big unit trust or mutual fund managers. And this is what they reckon. That's their curve. And once again, I'm just going to put on my little highlighter again. You'll see that they say if you're 20 to 30, you can have a huge amount of equities, percentage in equities. And as you get older, you should be coming down this risk profile. And you'll see they have different philosophies on this, but that curve tends to be about the same shape. And what I've then plotted is the 100 minus your age and the 113 minus your age, and you'll see that that does track that. So you can use this as a rough rule of thumb. Not everyone's going to fit on this curve, but you can see if you're 50 years of age, so let's take my age, I'm mid-40s. Literally, you would read off this chart, mid-40s, I'm looking to be somewhere around about 75-80% equities. That sounds about right for me. If you've got less, if you like less risk, you'll come down this chart a little bit, maybe you'll be at 60-70%. So hopefully that will be useful for you when you try to start constructing your own portfolio. Okay, so that's all the theory. So let's look at some real practical building portfolios. So the first thing you have to do when you build a portfolio is say, what do you think the market's going to do? Because clearly if you think the market's expensive and just about to fall, you probably don't want a huge amount of equities in your portfolio. So we do this every month. We our economist, our strategist has a look at the market and does what he calls a high road and a low road and a base case. So you'll see, and this is about a month or two old, but looking forward 12 months, we still think this market's okay. We think a bull case is you're still going to get about 28-29% performance. You know, the market has moved up in the last month or two, so it's probably a little bit lower than this now. But you're looking at performance for the next 12 months of definitely above 20%. That's the bull case. Bear case 12 months out from now is, a little sell-off, and you might take a little bit of pain. But if you look at our base case, we still think that this market's got about 13% left in it over the next 12 months. So clearly, that's better than inflation. So you must have equities in your portfolio. So first of all, start off like this and say, where do I think the market's going to go in the next 12 months? Then get a little bit more specific, because you need to kind of decide within that equity market, where are you going to spend your money? So this is, once again, from our economist, and this is as at the 31st of May. So a little bit out of date, but you know, if you want the more recent one, you can always send me an email, and I'll send you the latest one. We bring this out every month for our readers. So where am I going to spend my equities money? Well, clearly we like financials. We think they're going to do about 12.4% returns. We like resources. So I'm going to just to highlight as I speak, I bring my highlighter on again. This is financials, 12.4%. Resources, 12.7%. But offshore seems to also be the place to be at the moment, because we're forecasting slight rand. Well, the rand is kind of going nowhere. We're saying that's not going to give us much performance. But equity markets, we're looking to say that's still going to do 13% if you look at the offshore markets. So if you were then to build a portfolio at the moment, we would clearly have more of our equities in financials, resources, and a chunk of it in offshore. And I'll show you how to do that in a moment. Let's move on a bit. The other thing that you should do then is also within those asset classes, think about this strategically. So it's called your strategic asset allocation. So you go through each of the asset classes and do this exercise yourself and say, do I like currently, am I neutral? Am I overweight equities, domestic equities? Currently we're about neutral. Bonds we're neutral. Cash, we have a little bit extra cash in our portfolio at the moment because we are thinking that there might be a chance that we get a bit of a sell-off and then we can do some opportunistic buying. You'll see on the other side there, offshore, we are way underweight offshore bonds because we just don't see any value in earning no interest in the offshore environment. But we are slightly overweight offshore equities. So what we would have spent on offshore bonds, we're actually spending in our offshore equity portfolio. So do this sort of strategic asset allocation. You can see I've done it as a sort of slide ruler that I move backwards and forwards every month. Maybe play around, come up with your own model here. So then this is our asset. This would be our typical asset allocation at the moment. We're about 45% in domestic. So of our pie, of the money we're going to spend, we're typically spending about 45% in domestic equities. We've got 23% offshore equities. We've got a little bit in commodities. I'd like a little bit more than that, actually. I'd probably go sort of between 5 to 8% in commodities because I like what they do and they diversify my portfolio. Listed properties, 5%. This is our economist's view. We're probably a little bit more listed properties than that. Domestic bonds, 15%. And he's got a big chunk of cash. We never sit with 9.5% in cash. We think that's a bit of a waste. We'd probably have a lot less cash than that. So I've got some real asset allocations of our own one. This is our theoretical one that we work on with our economist. So here they are. So this is a typical product that we have on the shelf. It's a Vunani retirement annuity. So a bit of a pun for ourselves here. But you'll see you add more equity, the more aggressive you want to be. So there on the right-hand side, we have 75% in equities. And then we have the rest of the spread in cash, bonds, property, alternative investment, other. Other tends to be things like preference shares. We throw that in. So roughly 75% in our aggressive, 60% in our moderate, and our conservative, we're between about 35 and 40%. So those would be, you would need to fit yourself somewhere in one of those portfolios depending on your risk profile. So let's drill down into the medium. So this is what the exercise I'd like you to do yourselves. You can use our methodology to do this. So now we've decided that you're a moderate, let's say you've decided you're a medium risk type person. So you'll see we've got 37.5% in domestic equities. Now, I'll tell you how to spend that money in a moment. And remember, I am a financial service provider, so I can give advice. Equities international, about 17.5% currently in our moderate. Then we've got a little bit of alternative. You can use commodities, and I'll come to that in a moment. And then we've got listed properties sitting at about 21%, and then the other odds and sods, bonds and cash. So let's drill into how we would now fill up those bits of the pie. Property, you can either go and pick real estate investment trusts and go and stock pick them yourself, or you can just do the easy way, the lazy way maybe, and just go and buy one of the property ETFs. And that will give you very, very nice diversified listed property. And there's 3 to choose from at the moment. And to give a little bit of a punt to Stanlib, we'd probably put Stanlib in our portfolio because it has the lowest TER. Now TER is expense. So what you want to do is you want to buy your property exposure, but you want to buy it at fairly low cost. That now gives you your nice big chunk of property. If you are a lot more sophisticated, you can go and buy the growth points, the redefines, the NEPIs yourself. We tend to rather just go and buy the ETF, and it gives us a nice lot of property beta in our portfolio. The next one is, how do I spend my equities? Now, clearly your equities is your biggest component. So this shows you how we think. Our accelerated growth portfolio, quite an aggressive portfolio. We have things like MediClinic, Aspen, Pinnacles. Pinnacle, you probably had a rough ride in Pinnacle. Naspers is a great stock, gives you nice performance. Omnia, some of these names you'll recognize. So this is how we then take our equity component and how we spend it. If you're a client who's looking more for income and growth, then you might want with stocks that have slightly better dividends. So we have the Sassels of the world, the Discoveries. These things tend to have a slightly better dividend play. And then if you're a small cap junkie, and we do have clients who love small caps, you might have EOH, Mediclinic, some of the smaller caps, CMLs in your portfolio. So if you want to have small, mid-cap, and fledgling, you'll tend to have those sort of understanding that emerging companies, smaller caps, come with a bit more risk. So that's how we would spend our equity domestic portfolio. And then once you look at your offshore components, this is where life becomes interesting, because you've got a whole gamut of shares that you can buy. Tens of thousands of offshore shares. A lot of them are listed on the JSE via the IDX futures, but that's a topic for another night. But you can see the way we tend to play our offshore is we buy some nice DBX trackers which are on the JSE, and then we pick some of the stocks around that. So you'll see that we have a big passive component. Almost 60% of our portfolio is in ETFs, and then we add some shares around that, and you can do that using IDX. But that's, as I say, a topic for another night. So that's how we'd spend a sort of 20-25% offshore component. So hopefully I've taken you through literally, you start with the market, you determine where you think the market is, you then determine your risk profile, you say, where am I going to, what asset classes do I want to add into my portfolio? Then within those asset classes, so take, for example, equities, you say, what are sectors do I want to be in? And then once you've determined the sectors, what specific shares I want to buy. And that's how I would suggest a practical way for creating a well-diversified portfolio. Okay, I suppose I'm open for questions.
Yeah.
So I'm available. You can call me. My number is 384-2920, or email me at mark@vunaniprivateclients.co.za. I'm very happy to chat with and take your questions.